Steel producer ArcelorMittal South Africa said diluted headline earnings per share for the 6 months to the end of June fell to 166 cents from 449 cents a year earlier. That's down around 67%. The news sent the company's share price plunging around 6% in today's session, ending the day on a much lower level. And we also saw higher raw material costs and a stronger rand hitting its profits. On that note, let's get right into it.
ArcelorMittal market cap 33 billion, price earnings 125, and that takes today's numbers into account. Dividend yield 3. Jonathan, let's start with you. I suppose the share price really tells the story. The market was frankly expecting an uptick, and what they got was a fairly marked downtick.
Yeah, look, Mittal's in a very tough space. They've got massive cost push in terms of their input costs. The rand isn't helping. They've got this mess with Kumba and ICT. And really, it's quite messy and complicated at this point.
Okay, Richard, your sense on this? We saw ArcelorMittal plunging 6% at the close of trade. We know that we've had these dark clouds hanging over the company. Raw material costs seem to be a very big issue. Ian Cruikshanks from Nedbank Capital seems to think that it's also ArcelorMittal's aggressive pricing policies. Would you agree with that?
Well, look, to go back to the actual result today, I'm not so sure the market was expecting an uptick from the comparable period last year.
Yeah.
Most a higher number than 166, but not necessarily higher than the 450 we saw last year. I think more of the sort of negative movement of the stock was driven perhaps by the outlook. Management not very positive for the rest of the year. But turnaround from the second half of last year, the first half of this year was not that great, as you mentioned, compared to the first half of 2010. And I think the outlook was the big story, and they indicated again, well aware of it, that they need a recovery in construction here in South Africa, with almost 3/4 of their sales being domestic. With no sort of recovery in the near term seen for construction, the stock's definitely going to be under a lot more pressure than was previously expected.
Richard, you mentioned a couple of points there, and stuff that's, I suppose, to be fair to management, beyond their control. We've got the construction manufacturing sector in South Africa really under pressure. We've got that cost push, coke and coal up 59%, iron ore 23%, electricity up 28%. Really issues that there's not a heck lot they can directly do about.
Exactly. If you look at volumes are pretty much in line with last year. It's, as you mentioned, really out of management's hands. It's been one of our main arguments why we think iron ore prices should be the ones to retreat over the next couple of years, particularly for the fact, especially for someone like ArcelorMittal, being in a situation where they're barely profitable, and then you've got the iron ore producers coming out with EBITDA margins sitting north of 60%. There's quite a gap, obviously, between those two, and it just doesn't make sense. From the coke and coal side, there were specific issues last year coming out of Australia, and then obviously with a bit of demand push, you had the supply constraints as well. So that coupled, the two of them together drove prices through the roof, and we yet to see the worst. Management did mention that with the lag in the coke and coal contract pricing, we're going to see the worst coming through now in this third quarter.
Okay, so
which is why they expect significantly lower earnings.
Jonathan, operating margins at 5.6% versus 15.1%, and capacity utilization sitting at 76%. Some would argue that ArcelorMittal needs to start diversifying further. I'm not sure what that would entail.
They are looking to get more control over their iron ore input. They are looking at some mineral rights, but look, it's a very tough space. I don't envy management, and I'm glad I'm not in management. I wouldn't take that job.
That toughness, is it? Certainly the local story, we understand manufacturing, construction, etc. Well, China would have been picking up. Their exports were actually down 17%. Fierce global competition. What we saw in 2010 was globally ramp up in production, which means there's a lot more out there, which just makes it a significantly tougher market in a softer market.
Well, the biggest thing also for them is the strong rand. It really hurts them, because you're now starting to see imports of steel into South Africa, which really isn't good for them at all. So not only they're struggling to export, but they're getting hit with imports into South Africa.
Well, Richard, I mean, what would you say the likely scenario is going forward? Because it seems that they're also being hit with imports when it comes to the local construction industry as well. We're starting to see a lot of the companies and a lot of the local consumers starting to import more because it is just far more efficient, and the spot price that they could get steel at on a global level is far lower than what ArcelorMittal is offering. So why do you think that there is such a big disconnect? Why can we not produce steel competitively in the country?
Well, no, it's not even a case of competitively. I think, from their point of view, as Simon alluded to earlier, where management's being pushed from both ends. On the cost side, they're very much, despite having a favorable agreement with Kumba, this new arrangement that they have now, this pricing agreement, which has been renewed now for another year, it's still at double the level that it was at. So considerably higher. Yes, it's more favorable than international players, but less so than it was 18 months ago. And again, on the coking coal side, they're importing 60% of their coking coal. So it's really a situation that they can't control. And then on the other end, you've got government putting pressure on the steel pricing side and constant interference by the Competition Commission and industry itself. So, as Jonathan also said earlier, it's not a management team that you really want to be. They can be as competitive as they like, but then there seems to be too much interference.
Yeah.
Richard, we're talking, a lot of the stuff is, as we've said already, really beyond their control, the input costs, etc. Not the sort of stuff that management can directly handle. What I was trying to find, digging through the results this morning, was where's those sort of areas which they've got a lot of impact over, where we can look at and say, are management doing what they can manage right? Was there anything particularly that stood out to you where we can say, this is under management's control and they're doing it good or perhaps bad?
There was a question raised at the results presentation. I listened in, and one of the things, these issues that they've been having with the furnaces, and I think right now that's where you'd expect management to be totally in control operationally. On a pricing point of view and input cost point of view, that they really have little control. There's only so much they can push prices before they get more resistance, but operationally they need to be sound. We're expecting a shutdown now for 40 days at Saldanha. So those type of things we need to see running smoothly. We don't want any sort of, the only thing they can control is operational issues. And if there's any more to come through, sort of minute issues that are unexpected, that's going to throw the market again. That almost thinks management is not even controlling the few things that they can control. We haven't seen it in the past, but if those issues do start creeping through, then I think there's probably a bit more pressure on them.
Okay, so Jonathan, where to from here for ArcelorMittal? If we know that they lose the Sishen Cost Plus 3 contract completely, then obviously that is going to add more pressure.
Sure.
Again, we talked about diversification, and perhaps that could be a positive element down the line. But what glimmer of light and hope is there for ArcelorMittal? Give us the positive aspects, please.
I'll be honest, my positive list is actually quite empty. Obviously, a resolution on this in favour of ArcelorMittal with the whole Kumba iron ore agreement. If they can get back to cost plus 3%, which is where they were, that will be good for them. If we saw some commodity price weakness, and certainly in coking coal, which is their biggest input, which will also help quite a bit. So there's not a lot that they can do.
Okay, so Richard, crunch time, hot or not, ArcelorMittal?
Not at the moment. For the outlook management gave, it's really not something I'd be looking at. If you have it in your portfolio, you may be able to ride it out, but certainly not something I'd be buying.
Okay, and if you had to ride it out, how long do you think this ride out would last?
Look,
how long would you be riding
it's going to be a 12-month period. You're looking at a weak second half of 2011, and it all depends. You've got your three markets. If there's some kind of a global recovery and it follows through to South Africa, then it could be 12 months, could be longer.
Okay. Jonathan, I suspect that it's not hot for you.
No, it's definitely not hot for me. I mean, I like stocks where everything is going wrong because kind of nobody can see through the cloud. And I mean, look, I can't even see through the cloud in this one. So, no, it's
this
not
isn't the cloud, this is fog.
Yeah.
Difficult to see through the cloud. How about you, Simon?
No, not hot. Richard says if you want to ride it out. I mean, I don't. Since when? I mean, to me, the selling time was February last year when they first announced the problem with Sishen Iron Ore and losing that contract. Not hot. There's not a lot that they can. They need stuff just to happen in their favour. That they can't control it. They need management don't have enough control, and it's not their fault, but it's the way it stands right now. Not hot.
Okay, Richard, we have to say goodbye to you. Any last words before we do say goodbye?
Well, yeah, and I think we've pretty much covered everything. And as I say, it's a stock that unfortunately out of management's control. A lot of the decisions, we'll have to just wait and see what happens with everything around it.
Fantastic, Richard. Thank you so much for joining us. Much appreciated for your insights. Richard Hart, an independent analyst, joining us on the line from Durban. Now, electrical cables and lighting company South Ocean Holdings on Wednesday reported diluted headline earnings per share of 10.8 cents for the 6 months to the end of June 2011 from 15.9 cents a year ago. And that's a 32.9% decline. Management expects the traditional seasonality trend to continue with an improvement in performance during the second half of the year.
South Ocean Holdings, we've got a market cap of 243 million, a price earnings of 5.5, which on the surface is attractive, but we're going to scratch below that surface. No dividend. Jonathan, I mean, it sums up a margin contraction of epic proportions. Revenue up by 12.5, earnings down by 30-odd%. Margins have just been obliterated.
Yeah, look, I mean, Southern Ocean has two businesses. They've got their electrical cabling business, and then they've got Radiant, the lighting business. Now, the electrical cabling business, both, in fact, are heavily linked to the construction industry. Now, we all know that that is very much in the doldrums at the moment. So, you know, they've got quite big problems. And then if you look at the electrical cabling side, the biggest input cost is copper. Now, copper prices are up 20% year on year. So revenues in that segment is also up, I think it's 19%. Yeah. But margins have come down, profitability has come down. They've struggled to pass on those additional costs. Now, another thing with copper price increases is the inventory. If you've got the same number of copper coils it's sitting in your warehouse, which you need, it's now 20% more expensive. So it just knocks your cash flows. Their cash flow has been pretty weak.
And of course, evidence in those operating margins sitting at 4.8% from 7.5%.
Yeah. Sure, I mean, you know, it's very, very tough for them at the moment.
They're managing, I mean, operational expenses, again, look at those things which management can control. Operational expenses seemingly under control below inflation. You've got to say, you know, the copper price, okay, they can't control that, but certainly the operational, and they're getting that right. So management's managing what they can manage. They're just finding that tough time. It comes back to, as you said, it plays into construction.
Yeah, plays into, I mean, as you were saying, I mean, I think they've done a very good job containing costs. I mean, they've also got they're expanding their production at their Elrope facility for copper. So they're spending a little bit of money on that. I mean, is that the right decision at this point in the cycle? I'm not sure. There's also a new CEO, I think it's Mr. Pan has now stepped aside. So, I mean, I quite like it when there's a new CEO because there's new, fresh ideas.
He's going to come in and shake things up a bit, perhaps.
Well, perhaps. He was the chief operating officer, so it's not completely...
not that much shaking.
Yeah. So where's the growth going to come from going forward?
Well, I mean, this is a construction play. I mean, we need to see new hotels, new offices being built. I mean, that's not a short-term thing that's going to happen anytime soon.
And in that sense, in construction, are they going to be later in the process? And if you start building a hotel, as you suggested, or something, the wiring's coming. There's a bit of upfront wiring to get the infrastructure in, but the actual wiring within the building, etc., that's kind of towards the end of the process. So they're going to be late cycle when we start seeing that pickup. Yeah,
no, look, sure, they are definitely more later in the cycle, but the share price will react sooner because everybody will start pricing in the improvement in earnings.
Price earnings 5.5 on the surface looks attractive, but in truth that's telling us the picture that it's been under serious pressure more than saying it's offering significant value.
Well, I mean, also that price earnings is historical price earnings. If I look forward, I think maybe it did 10 cents this half, it might do 24 cents for the year, so I mean it's probably closer to 7.
So are you a believer that the construction industry will recover significantly and there will be more hotels and offices built?
Well, I mean, no, not
I'm actually alluding to whether you think it's hot or not.
Well, I mean, I'm going to say it's not hot. I don't know the company that well. I mean, I think the thing to do is to go spend some time with the new CEO, go and scratch his brain, see what he thinks. But at this point, no, not hot.
Not hot. Okay, Simon.
Not hot, no. I'm intrigued by it. I don't like the Radiant. The light fittings and stuff doesn't inspire me. The copper cables I quite like. I'm not sure about the IP, but they've got the manufacturing, etc. But at this point in the process, I think they're going to be late cycle, and the price will preempt.
Simon, you're so optimistic about the construction industry.
Yes, but construction first has to start happening, then these guys can start selling me some cables. And optimistic's a strong word. I just think construction can't get any worse.